This Week in Economics on the 25th of February 2017. Numbers man here from WBRN Radio in Boston and on the Bostonred Network. As we consolidate our various broadcasts, we invite you to listen to the other broadcasts under the umbrella Bostonred, that's the political broadcast, and the Open Source Report, which is a technical broadcast. And not least, BR on the World, which is our international broadcast. Doesn't come as much, but it does come from the international standpoint. And within a week or two, we are starting All About Sports. That will cover sports, the politics of sports, the economics of sports, etc. But on to the economic picture today. We'll start to look at some of the information from the U.S. economy, and then we'll look at the economy in the EU from the BBC and the world. We'll start out with our market flash, U.S. PMI. The U.S. Private sector growth slowed in January from January's 14-month peak. Flash U.S. composite output index at 54.3, and it was 55.8 in January, a 2-month low. This was issued on the 21st of February. And let me get into it here. The U.S. Service Business Activity Index at 53.9. It was 55.6 in January. That's a 2-month low. The Flash Manufacturing PMI at 54.3. It was 55 in January, a 2-month low. And the U.S. Manufacturing Output Index at 55.7. It was 56.7 in January, another 2-month low going on there. And the market composite PMI in U.S. GDP at 54.3 in February. The seasonally adjusted market flash U.S. composite PMI output index dropped from 55.8 in January, but remained above 50. That is the line. No change of value for the 12th consecutive month. The latest reading signals that the private sector output growth moderated from the 14-month high recorded at the start of 2017. Weak business activity growth was mainly driven by slower momentum across the service economy. The flash index at 53.9, down from 55.6 in January. Manufacturing production continued to expand at a robust pace in February. The index at 55.7, down only slightly from 56.7 in January. Service providers' outlook for growth over the year ahead, and the latest reading signaled that business optimism was at its weakest since December, which contrasts with a 20-month high seen at the start of 2017. The seasonally adjusted U.S. Markets Flash Manufacturing Purchase Managers Index signaled that manufacturing business conditions improved slightly at a slightly slower pace than in the 22-month peak seen in January. Soft output and new order growth were the main factors weighing on the headline PMI reading during February. Despite a slowdown since January, the latest survey indicates that new order growth remains faster than at any other time since March of 2015. This is driven by strong sales to domestic clients, which helped offset weak growth in export market. during February. A large number of manufacturers commented on the great demand for energy sector from energy sector clients. Meanwhile, manufacturers signaled that input cost inflation was at its highest level since September of 2014. This was linked to increased prices for raw materials, particularly metals and oil-related products. However, factory gate price inflation was only marginal and slipped to a 3-month low in February, thereby suggesting a continual squeeze on operating margins. And let's go up here. The latest survey data indicates that business optimism moderated among private sector firms in February, driven by a weaker confidence across the service economy. Measured overall survey respondents were the least upbeat about growth since September of 2016. The composite index is based on the original survey data from Market USA Service PMI and Market USA Manufacturing PMI. The flash U.S. Service PMI, adjusted for seasonal influences, business activity index registered 53.9 in February, down from 55.9 in January. Needlessly, the average index reading for Q1 of 2017 so far, 54.8, indicates the service sector is still on course to register its fastest quarter growth since 2015. The slowdown in the service sector growth from January's 14-month high largely reflects a moderation in new business expansion to its weakest for 5 months in February. Some service providers commented on a greater degree of caution in terms of client spending. However, there's also reports that supportive economic backdrop and increased customer budgets have underpinned sales growth. Service sector job creation moderated to slowest in 3 months in February. Anecdotal evidence suggests that the reduced pressure on operating capacity and squeezing margins have contributed to soft economic growth. February's data signal a sharp moderation in service providers' outlook for growth over the year ahead. The latest reading signals that business optimism is weakest since September, which contrasted with a 20-month high seen at the start there. From Dr. Let me just a minute here. From Dr. Williamson, he is the chief business economist at IHS Markit. The drop in the flash PMI numbers for February suggests that the post-election upturn has lost some momentum. Growth of business output, new orders, and hiring all weighed, as did inflationary pressures. February also saw a sharp pullback in business optimism about the outlook over the next 12 months, which suggests companies have become more cautious about spending, investment, and hiring. However, even with February's dip, the PMI remains at a level broadly consistent with economic growth at 2.5% annualized rate in Q1. The survey employment index is meanwhile indicates that a respectable 165,000 jobs were added in February. And this is very interesting. We're starting to see a little of what will happen in the so-called new economy under the new Trump administration. Now, as we reported, I believe 2 episodes back, there was exuberance, and according to the term to fall back, I should say, on the term from Dr. Greenspan, somewhat irrational exuberance in that the plans of the new administration had not consolidated and still have not to date. Now, there is a lot of apprehension out there because people do not know where things will settle. Very difficult to tell. One of the caution signs is always in an industrial capitalist society, even if things are going well. In other words, if growth, say, at your GMP, your growth is at 3%, you still run a risk of a recessionary climate coming, and it would really depend if the recession is a hard recession or a moderate recession. Now, at 2.5, that type of growth would be better than before because it was less than 2%. But we'll look at the UK economy, and there are some conditions in the two. Now, if we, I was looking at some of these. Well, we can look at the Eurozone. We do have time to do that. And we'll sum it up. Eurozone steps up, excuse me, a gear as growth approaches a 6-year high in the Eurozone. Now, this is also dated on the 21st of February. The Eurozone PMI Composite Output Index was at 56. It was 54 in January. Now, that's a 70-month high. Eurozone Service PMI Index was at 55.6. It was at 53.7 in January. Another high, the Eurozone Manufacturing PMI Output Index at 57.2. It was 56.1. Again, that is a high. The Eurozone Flash Manufacturing PMI at 55.5. The pace of Eurozone economic growth improved markedly to hit a near 6-month high in February. Job creation was the best seen for 9.5 years. Order book growth picked up, and business optimism moved higher on all boarding well for the recovery to maintain strong momentum. In the coming months, the market Eurozone PMI registered 56 in February, according to preliminary flash estimate. Growth accelerated in both manufacturing and service to rates not seen since 2011, with a good producing sector again enjoying the fastest rate of expansion. February also saw the largest overall increase in new business since April of 2011. Firms' average input cost rose at the steepest rate since 2011, with rates accelerating in both service and manufacturing, latter once again recording a steepest rise linked to higher global commodity prices. That we keep an eye on. Suppliers delivery time, a key gauge of supply chain capacity constraints and pricing power, indicated that delivery delays were most widespread since 2011. By country, the growth accelerated to show similar robust rates in France and Germany, where the composites of 56 and 56.2 and 56.1 recorded respectively. Both countries saw new orders rise at steepest rates since 2011. The key differences was pricing, whereas both saw input costs rising at a rate not seen since mid-2011. French firms continue to report falling selling prices, while German output prices show largest monthly increase since 2011. Elsewhere in the Eurozone, the rate of growth for business activity hit a 14-month high. Job creation rose to the highest in 7 months, but costs also slowed the largest rise since August there. And from Dr. Williamson on the Eurozone, economy moved up a gear in February. The rise in the flash PMI to its highest since 2011 means that GDP growth of 0.6% could be seen in the first quarter if the pace of expansion is sustained into March. Inflows of new orders and also surges, and firms have become even more optimistic. Ahead, growth could even lift higher in the coming months. A survey therefore indicated that companies are currently firmly focused on expanding the face of rising sales and fuller order books. The big surprise was France, where the PMI inched above that of Germany for the first time since 2012. Both countries look to be growing at faster rates equivalent to 0.6 to 0.7% in the first quarter. The France's revival represents a much needed broadening out of the region's recovery and bodes well for Eurozone upturn to become more self-sustaining. The EBC will be cheered by signs of stronger growth, and further upturn in price pressures will no doubt remain a concern. That elections and a Brexit could disrupt the business environment this year. No change in policy, therefore, looks likely until at least after the German elections, and those will be in September. Okay, let's move back here to the U.S. I'll look at tax rates here, and this is one part of the puzzle that people at this point in time do not know. We'll look at the top tax rate. Now, this is 2016 tax rate. This is for $415,000 or more at $120,000 plus 529 plus let's see, there's the rate starting there. That's a start at 120,000 roughly. At 39% is the rate, plus 39% of the amount over 415,000. So that, in other words, the top rate is at 39%. Under President Eisenhower and his administration, it was 80%. So in other words, rates have dropped to 39. Now, under the new proposal, don't even know exactly where it is, the rates could be cut by 20% or to 20%. So we start out with a 10% rate. That's roughly for people making about $10,000. Now, this is without deductions, and so the average would fall at about 15%, a little over 15%, and if you from 37,000 to 191,000, where most people would fall, would be about the 25% tax range at $5,183.75. Plus 25% of the amount over 37,000 roughly. So, in other words, you'd be somewhere at about 25%. So that would drop by about 5%, depending on where the scale would be. Actually, if your rate dropped by 20%, it would actually be more than that. It would drop to about 5%, and these other categories would be wiped out. The 10% for what is that? The 10% for roughly about $10,000 and up to $37,000 now at tax now at 15%. Those rates would disappear out of the tax scheme. So in other words, basically speaking, you would start at, and those rates have not been worked out to date. So in other words, your 25% or 26% or whatever would disappear if, depending on how you got your, if it were 20% across the board. Now this is not the corporate tax, but the corporate tax is also cut from, it's roughly about 40% now. To about 20%. Didn't have the corporate rates up here. We'll talk about those later. But again, all of this is up in the air at this point in time. Now let's move on to the other news here. How we just bring that up. And we'll start here from Reuters and we'll move on. New home sales rebound here. Single-family home sales rose less than expected in January. January is always a slow month, traditionally. Likely held back, of course, the rains and floods. These are so-called natural disasters in California. Other data on March, on Friday showed a dip in consumer. We'll get to consumer confidence in a minute here. Well, let's do consumer confidence, then we'll get back to some of that part of it. Anyway, nonetheless, in February, the index of consumer sentiment is at 96.3. In January, it was at 98.5. In February of last year, it was at 91.7. Current consumer conditions at 111.6. That is in February, and 111.3 in January. Last year it would be 106.8. And the index of consumer expectation, don't see that as much. At 86.5, it was 90 in, and you can see a little bit of this exuberance here, 90.3 in January, that's of 2017. It was 81.9 in February of 2016, a negative 4.2 there. Consumer confidence edged upwards in late February, if it remains slightly below the decade peak record in January. Overall sentiment index has been higher during the past 3 months than any time since 2000 and March 2004. Normally, the impact would be that consumers expected Trump's election to have a positive economic impact. The implication, that is not the case since the gains represent the result of an unpredicted partisan divergence, with Democrats expecting a recession and Republicans expecting robust growth. Indeed, the difference between the two parties is nearly identical to the difference between the all-time peak and the throttle value in the expectation index, 64.6 versus 64.4, while expectation of Democrats and Republicans largely offset each other. The overall gains in expectation index was due to self-identified independents who were much closer to the optimism of Republicans and the pessimism of Democrats. Note, in February, the expectation index was 55.5 amongst Democrats and 120.1 amongst Republicans, and 89.2 amongst independents. Since neither recession nor robust growth is expected in 2017, both extremes must eventually converge. Although the data indicates a growth rate of 2.7 in consumption during 2017, the data also indicates we could expect greater volatility and discretionary spending differences across subgroups. Now, this is very important. This is from Dr. Curtin. He is the chief economist of the survey. Now, looking at the difference here, this is sort of a gold mine. It's 55.5 amongst Democrats and 120.1 amongst Republicans. Now, the Democrats have a much, much larger spread, and 89.2 amongst independents. So the independents are about 30 points down from the Republicans, and they are roughly about 40, well, not quite, 35 points above the Democrats. But since there are more Democrats out there than Republicans, now you throw in independents, gets a little bit challenging here. Now let's go back to the Reuters article. Now we continue with some commentary. It's clear the economy is moving towards solidity. Consumers are confident and are buying homes, but builders are not getting their share of that demand. That's from the chief economist at Naroff Economic Advisor in Holland, Pennsylvania. The Department of Commerce said new home sales increased by 3.7 to a seasonally adjusted rate of 555,000 units last month. That's good for January. Economists forecast single-family sales, which account for 9% of overall housing sales, surging at 6.3 and 570,000 units. New home sales, which derived from building permits, are volatile month to month. Their sales were up 5.5% in January of last year, 2016. So 2016 was a better year. We break it down regionally here. Home sales are soared to 15.8% in the Northeast, to their highest level since January of 2008. They rose 14.8% in the Midwest and advanced 4.3% in the South. Sales in the West, which have been hit by fell actually 4.4%, but that was because of extreme climatical conditions there. The unusual wet winter has held back sales in January, but sales are still trending higher on a 3-month moving average basis. That is from Mr. Wittner. He's a senior economist at Wells in North Carolina. In separate reports, the University of Michigan said the Consumer Sentiment Index fell to 93.3 this month from 98.5. The index has surged in the past 3 months after the prior 3 months after the election of DJ Trump. With the focus shifting from campaign promises to philosophical goals, consumers may be acknowledging the difficult task ahead for the administration to actually advance the agenda. That is from the Chief Investment Officer at Plant Moran Financial Advisors in Kalamazoo, Michigan. U.S. stocks were trading lower on Friday, with the Dow averages on a track to snap a 10-day record high. The housing index fell marginally. That's the PHLX index. Housing market has firmed even as the 30-year fixed mortgage rate rose to 4%, outpacing annual wage growth that has been stuck below 3%. While a healthy labor market has not unleashed a strong piece of wage growth, but a shortage of properties available for sale remain an obstacle to the housing market. Mortgage rates aren't to blame, according to somebody named Jonathan Smoke. He's at Realtor.com in Atlanta. He claims that challenges are faced to builders that like regulatory burdens, labor shortage. Well, labor shortages will remain. The inventory of new houses on the market increased 3.5% to 265,000 units last month, the highest since January of 2009. New housing stocks remain less than half of what it was at its peak during the housing boom of 2006. Well, you would not equate this to the housing boom. First of all that housing that wasn't destroyed has been sold. The January sales pace, it would take 5.7 months to clear the supply out, which was unchanged from December. 6-month supply is viewed as a healthy balance between supply and demand. The median price for a new home increased 7.5% to $312,000 in January. $312,900 from a year ago. So in other words, houses are more expensive to buy, and compensation or wages have not moved up. So we'll see where that ends up. Now we'll look at new residential sales. This is from the U.S. Census Bureau. Following residential sales statistics for January, houses sold 555,000, new houses for sale 600. Still do the same thing, 265,000. And this is the same figures we just got, but new home sales in January 2017 was seasonally adjusted for an annual rate of 555,000, according to estimates by the U.S. Census Bureau and the Department of Housing and Urban Development. This is at 3.7% above the revised December 535,000. That would be at 5.5% above the January 2016 estimate at 526,000. The selling price was in January of this year $312,090. The average the average sales price was $360,000. Inventory won't go over that. And that's basically it. We broke down the region, so we won't do that. Now, this is from the Los Angeles Times. New survey of consumer confidence in Los Angeles fell in the fourth quarter. This is on the 7th of February. This is the inaugural index from Lowe's Institute of Political Economy and the Claremont McKenna College stood at 106.3, and the index down 12% from 120.8 in the third quarter last year, down 7% from 114.2 in the fourth quarter of 2015. The drop may have been driven by unexpected election of DJ Trump, the Institute said, noting that the majority of LA County is deeply Democratic as their views oppose the new administration. Another tick here. What you're noticing a trend as we were looking at the survey from the University of Michigan, the survey here that politics and economics are colliding. The index intended to help provide, this is the Lowe's Index, a future guidance about future consumer spending in Los Angeles. And the fourth quarter dip is a cautionary note that is from Mac Vindemeyer, the Institute's director. Is a knee-jerk reaction to the election, or is it a knee-jerk, or is it a pattern that is persistent? Wiedemeyer said we'll have more information in Q1 of this year. The Institute developed the index because the national consumer sentiment is measured by the Conference Board Group, the University of Michigan, and others. The outlook in consumer in Pacific areas such as Los Angeles has been absent. We'll add this to what we do in the Lowe's Institute Index. 500 randomly sampled people in LA County were asked several questions in whether they believe business conditions would improve in the next 12 months or whether they expected to be better off financially in the next 12 months. consumer confidence amongst respondents age of 44 and older, and those 55 and 64 showed sharp declines in the fourth quarter, while age 45 to 54 and 65 plus showed an upsurge in consumer optimism, the Institute said. The Institute also showed that gathering consumer confidence data in Orange County has started. And he put that into the index. They are down in Orange County. Anyway, that is the Lowe's index. We'll try to get to the bottom of that and see exactly where we are here. And we'll zip on here, and we'll this is on the 7th. We'll wait a minute, just a second here. Well, anyway, we will append this information here, and we see Mr. Wiedemeyer here, etc., and we'll get that done. Nonetheless, we'll let me look at our time, and we'll go to the BBC now and get this information from the BBC and do our numbers. The UK growth to slow as economy rebalances. This is from the BBC. The British economy will see 3 years of relatively slow growth as it comes to rely more on trade and less on consumer spending. That is from a think tank. The influential EY Item Club says higher inflation caused by a weaker pound would result in GNP growth at 1.3 in 2007 and just 1% next year. Now, that is their forecast. The Item Club expects imports to increase by 3.3 this year and 5.2 in 2018. From the chief economist there, Peter Spencer, said that the fall in sterling after Brexit's vote signals a permanent shift in the fundamental value of the currency. We know that it will crash consumer spending, and we see progressive slowdown in retail sales as indication like that this year, he told the BBC. Now, this is very interesting here from a global standpoint, and also the new administration's reliance on partnerships with the UK. He said the weak pound should boost exports in the near term, but the trade and growth in 2019 beyond would largely be returned by terms of the Britain's exit from the EU. If exports did not pick up, the UK could be stuck in a slow growth economy. We'll see on that. We'll start to see more banks, especially pessimistic, with 90% saying they're preparing for the impact of Brexit was their biggest challenge. And some of the banks are also talking about moving. The consultancy, which surveys 103 financial firms on behalf of the Confederation of British Industry, found 2016 to be the gloomiest year for the sector since 2008. And that is that particular estimate there as to where they are going. And we'll put it on our Twitter feed, the rebalancing there, and we'll get this also on the Cranston Analytic page. Now let's fly back to the, we would get this government finances. Now this is on the 21st, recorded 9.4 billion pound surplus in January. So things are a little bit more rosy there. Yeah, let me see. Is this today? Yeah. I'm going to have a lot of headlines here, with the exception of Google is suing Uber. That's the self-driving cars there. Yeah, we'll take a look at it, and then we'll do the numbers. The little Google car is flying along. Waymo, set up by Google and Alphabet, is taking a legal action against Otto. That's the self-driving vehicle from Uber, for $70 million. Suit argues that the former Waymo manager took information when he left to co-found a venture that became Otto. Well, Waymo and Otto, difficult to bring legal action anyway. This is a strange lawsuit between two, but it's information out there. Anyway, what more can we say about that one? The battle of the self-driving cars. Incidentally, in the U.S., Boat automobile will be manufactured. Self-driving version will be manufactured, so that is coming and coming very quickly. Incidentally, Ivory Coast faces a cocoa crisis. Price drop there. We'll take a look at it before we do the numbers. I've always been interested in the Ivory Coast cocoa farmers face a financial crisis. It's usually always happening. Ivory Coast is facing unprecedented cocoa crisis, and it is all down to price. The international price has fallen sharply since 2015. The parts of the world like China and India haven't caught up with Europe and North America in their love for chocolate as quickly as expected. The price is down 40% from July of last year, coupled with the fact that the Ivorian government raised the price that farmers get has meant cocoa buyers who buy their stock a year in advance suddenly face massive losses if they honor their contracts. Up to 80% of buyers have backed off their contracts, leaving farmers like George penniless. This is the world's largest cocoa port, and traffic is usually unbeatable, huge, etc., etc., and it's very slow. Factories are closed, trucks full of cocoa are backed up along the roads. I've been here for a month and 15 days from one truck driver. So it is a slow situation here, showing cocoa in bags, all, as they say, stacked up. Of course, any commodity can get hammered, and cocoa is getting hammered. That is one of the functions, and unfortunately, for a country like the Ivory Coast, it is not good news. But when you're in a global economy, cocoa or chocolate is not the favored item in China, and specifically in Asia. You don't have cocoa, so therefore you are faced with the European markets, and those markets are tapped, or who knows what people are eating. Maybe their own healthy diets. But I noticed the last time I purchased a chocolate bar, I didn't see any decrease in the price. So maybe the manufacturers are having a quote-unquote field day. the markets, finally. This is from the BBC, and I think most prices will be Friday unless otherwise noted. We will see here. The BBC Global 30 on Friday was at 24.24. In London on Friday, the FTSE All Share was negative 14.43. In Amsterdam, they were negative 2.73. In Frankfurt, the DAC, negative 143.80. In Paris, they were negative 46.05. In Brussels, a negative 31.62. In Madrid, a negative 39.90. In Zurich, negative 43.47. In Moscow on Friday, negative 13.21. In Johannesburg, a negative 294.82 on Friday. In Bombay, they were actually in the positive 20 territory at 28.26. In Karachi, that was on Thursday, incidentally. In Karachi on Friday, they were negative 54.24. In Lahore, they were negative 45.11. In Colombo on Thursday, 8.45. And in Tehran on Wednesday at 47. In Sydney on Friday, negative 45.60. The Nikkei, negative 87.92. And Hang Seng in Hong Kong was at negative 149.16. And in Shanghai on Friday, 2.06. In New York, 11.44. The Nasdaq was at 9.80. And the Merck, that's the commodities market out in the Midwest city of Chicago, was at 3.53. In Sao Paulo, on Monday, they were at 1,046.717 in the negative, and on Friday in Mexico, 648.42 in the negative there. A lot of negatives going on. And to the commodities. We'll start with Brent crude. This is from IEC Futures Europe. What do we have here? Brent crude was down 54 cents, but at $56.04, and on the spot was down 46 cents at $56.20. West Texas Intermediate was down also 40 cents at $54.05. T-Boone picking junking for joy there. You remember $15 a barrel. Oil. Coffee, let's see. Yeah, coffee was down $3.45. Gold on the Forex was up $18. Yeah, let's see. Depending on which index we take. Oh, I see. Well, we'll take the later index, I suppose. Anyway. The PM index was up $5.75 at $1,253.65. Dubai Gold futures were up $8.50 at $1,258.50. Silver was up 27 cents at $18.27. On we go. To the Internet Life futures. We'll get cocoa down $26. You can see what's going on here. Robusta coffee down $34. White sugar futures down $6.30. So all the commodities were down. The Bloomberg index at 87.48 on a Friday. So it actually was up 11 cents. This will do it for us on the 25th of February 2017. For those in business, make next week a productive one. And for the consumer, keep your eye on the prize as you have been doing as of late.